Welcome back. This is Si Wing Yi from the Year Real Estate Network, and today I'm going to talk about something is extremely disturbing. If real estate investors are not taking action or not evaluating their real estate portfolio, they are going to crash and burn. This topic I'm going to discuss is not being talked about in the mainstream media, is not being talked about in the social media, but it's coming. The sooner you're prepared to pivot, the sooner you're prepared to adapt and rebalance your portfolio, the better off you're going to be. Because this is a generational real estate failure by a lot of people. Okay, a lot of people are just a lot of investors are they have no clue what's going on. But well, let's go through what I'm trying to say. So with that in mind, before I'm going to share my screen, here's the deal. The deal is the biggest challenge in the real estate investment housing market is not about housing crash, which is not going to happen based on today's numbers. It's not about inflation. It's not about housing shortage. Yeah, I mean, it's not about anything or the mainstream media's all the headlines you've been hearing, not only recently but in the past few years as well. It's about our houses in the country are getting older, and that's going to have a potentially an adverse effect on real estate investors who own some of those rental properties in certain areas of the country. All right, so this is I'm just kind of shocked people are not aware of what's going on. But look, I've been a real estate investor for several decades. I have numerous properties spread across the U.S. I've helped thousands of mom and pop real estate investors to buy new construction, cash flow, turnkey properties in the emerging markets, mainly in Florida and Texas over the years. But anyway, so let's go through my screenshot. Here's the deal. What's going on, which is not being talked about. America's housing stock is aging at an accelerated pace, a trend most market conversations clearly overlook. Okay, so the median home of houses in the U.S. are 42 years old, owner-occupied homes. Okay, the median age in 2005, those homes are 31 years old. Okay, so and look, there are 49 million households, and there are 200 billions of cost of repair backlog nationwide. Listen, let me backtrack a little bit. A lot of my friends and fellow savvy real estate investors who have a large portfolios, you know what they're doing? As they're getting older, they have purchased their real estate portfolio, numerous rental properties, mainly in the Midwest and few other areas throughout the country. Their rental properties are getting older, okay? And a lot of my savvy investors who own 30, 40, 50 rental properties in their own portfolio, you know what they're doing? Either they're doing one 1031 tax-free exchange to exchange into a newer construction properties so they could create a generational transfer. How can you create a generational transfer on housing property when the age of your rentals are so old? You're going to incur so much capital expenditure, the capex cost, and all the repairs and maintenance and everything else. When you're getting ready to retire in age 50 or age 60s, holding those old rental properties, yeah, you could be stressed out. You want to live your life, you want to achieve your lifestyle retirement. You cannot be bothered with tenants and toilets. You cannot be bothered of self-managing or whatever of this increasing cost of repairs, maintenance, vacancies on those much older properties in presumably rough neighborhoods, right? So a lot of our investors and we talk all the time because I have a network of savvy investors that are or who are my friends who knows in the yeah, social media, YouTube channels, and everything else. And I talk to them a lot, and they're telling me, "Look, see, Wing, I am really tired of owning the properties. When I retire, I'm not going to be dealing with the tenants and toilets. I want simplicity. I want a simple life. I don't want to be bogged down with a second job managing my own real estate portfolio, especially a portfolio of houses that are 50, 60, 70 years old. I can't deal with that. Even if I have a they tell me even if I have a property management doing everything for me, I'm still seeing my returns, my numbers, my cash flow, and everything has gone down because of the increasingly excess repairs and maintenance of my very, very older properties. So the savvy investors, like I tell you, that I know they are getting smarter. They are selling their older rental properties and they are exchanging into newer construction properties. So newer constructions allow them to keep their portfolio, keep them stress free, and so they don't need a second job. They buy turnkey whatever properties and they let professional property managers manage their properties while they can go off the sunset and retire and travel, whatever, and don't deal with the headaches of managing their large portfolio. So they are rebalancing, you know what I mean, right? But however, all those newbies out there that who are arrogant investors who purchased their rental properties at the during the pandemic, during the amazing appreciation play during the during COVID, and they're getting some low interest rates, and the houses appreciate very fast. Those beginning investors, they think they know it all because they make a lot of money back in 2020, 21, 2022. They're able to buy a lot of these cheap properties for high cash flows and getting some good appreciation, especially even in the Midwest markets, those older homes they think they've done well. They're self-managing. Those beginning investors back in 2020 they have done well, right, when they purchase those properties. But now, as we fast forward into 2026 and beyond, they are having a lot of regrets. And they made a lot of money up front. Don't get me wrong, right? Pandemic housing booming, and they're all profiting during the first few years of ownership. Now, when I evaluate their portfolio, those newbies out there think they have done very well. They have done very well, but they bought, not in the best neighborhoods, right? In the Midwest, low cost, high cash flow properties. They achieved a lot of cash flow, a few years ago, but now, those Midwest markets with just aging stocks are really hurting them. They are beginning to see the headaches, the stress of self-managing those portfolios in the Midwest markets, and a lot of costs, a lot of the roof or caving the electrical system, or getting too old. They have to and there's a lot of vacancies. There are tens of thousands of dollars out of their pocket to maintain their portfolio. So you cannot sustain it. You cannot sustain. You cannot say to yourself, when I for the next 30, 40, 50 years, when I pass, I'm going to pass on all this nice real estate portfolio to my children and grandchildren or for the loved ones, and what we call it generational wealth transfer. How can you achieve generational wealth transfer when all these 50 to 100-year-old rental property you own in the Midwest continue to lose money, right? You're not going to achieve your goal generation. You could sell the property way, way before you're ever going to retire. So again, to me, this is a wake up call. All right. So let me share with you my slideshow as I conclude, as I finish this up. So look, rising maintenance costs, deferred repair accumulation, shrinking rentability, market divergence. Housing supply is no longer just about building new homes. It's about whether existing homes you own or can stay functional, can stay affordable and rentable for renters in the long term. So again, the market is a market divide. Older restricted markets in the Midwest, especially have a lot of issues, aging stock, deferred maintenance, a risk of all these kind of risks, as I stated here. But if you buy newer homes, new construction, right, cash flow homes, turnkey, low entry level costs, especially in Florida and Texas, you have faster permitting, repair approvals, newer average housing stock, lower carrying costs, easier to maintain, easier to rent, better quality renters, stronger long-term asset valuation retention. All right. So again, just to go to show you what's going on, right? All the potential repairs for years down the road and housing stock. It's really becoming problematic, right? So you want to. I like hands-off turnkey property where I can sit and forget it, where I can spend 1 to 2 hours managing my portfolio long distance, regardless how far it is my properties, because knowing that I have a quality asset, right? New construction, newer construction, cash flow, turnkey properties in growth markets, emerging markets. That's the ideal situation. But right now, you really, all of you investors out there, especially the younger folks out there in your 30s and in your 40s, thinking you bought three, four, five properties. You did a great job of doing the BRRRR strategy 5 years ago. You buy, you renovate, you refinance, you repeat, and you do it more. The BRRRR strategy, it may not work anymore these days, right? Real estate investing has changed drastically today based on higher mortgage rates, higher maintenance costs, higher taxes, higher insurance, and hard to cash flow these days, right? Today is very challenging, right? So you have to become a very, very savvy investors in order to survive in this real estate investing world. And a lot of people they're gonna crash and burns if they do not adapt their mindset, if they do not rebalance their portfolio, if they don't think about the future, where to buy, what location to buy, and this and that, right? So the fixer upper myth, fix roll up, I fix rubber, I buy distressed, I find a motivated seller, then I negotiate a 30% discount, whatever. Yeah, that's historically is a great strategy. This is a buyer's market and what have you. But it's not that simple, right? It's not that simple, right? It's a lot of work, okay? So the traditional wisdom is, you buy cheap, you renovate, you force appreciation. But the reality today is renovation cost is skyrocketing, right? Contractors are very scarce. There's a lot of scams out there. A lot of contractors will scam you, and I know that, right? I've been there, done that. I went through many different real estate cycles in my lifetime. I've done a lot of investing. I know a lot of different markets, and I coach and mentor my turnkey mom and pop real estate investors, mainly from California, to buy out of state long distance in a good quality areas, new construction, cash flow, turnkey type of property, so they don't have to trade time for freedom, right? They want to restore the time freedom. They don't want a second job, right? They want a good investment return. They don't want to the stress and the headaches and of managing the property, just tenants tenants and toilets and stuff. Okay, that's not my cup of tea, right? Okay, I'm an investor. I'm not a landlord, right? Landlord, you have to do everything yourself. I mean, self-manage all this high stressful thing. That's not my cup of tea. Hopefully, that's not your cup of tea either. All right. So again, today's distressed property discounts is shrinking. It's very hard to find cash flow. I know today's a buyer's market. It takes a lot of time to make the right deals. Yeah, there's a lot of deals out there, but you really have to hustle. You really have to do your due diligence. You have to work the right team, the right market, the right neighborhood, and all the whole 9 yards. So fixer upper myth is not the way it used to, right? So the hidden cost of old homes, the longer you own these older properties, especially in the Midwest. What I mean by that, Midwest is Cleveland, Ohio, Indianapolis, Indiana, Green Bay, Wisconsin, St. Louis, Missouri, or 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 or, or Chattanooga, Tennessee, or Dayton, Ohio, or Gary, Indiana. All these, blue collar, Midwest states where housing cost is very, very low, cash flow is very high, but the housing stock, the properties are very, very old, 50 to 100 years old right now. So therefore, you're going to until you evaluate, look at yourself in the mirror. I mean, is my portfolio that I purchased back in 3, 4, 5 years ago, are they still going to perform to my expectation, especially those older property in the Midwest? I think not. All right. Okay, you think some of you are thinking, some of you are thinking, oh, I'm really trashing on a Midwest property. No, not really. There are a lot of people still doing well buying those older rental properties, low cost, very old homes, good cash flow, even a little bit of appreciation. So I'm not trashing, but I could see this coming. I've been around for a long time, and I know from a high level, what markets, what type of property, what neighborhood will do well for you for the long term. So the hidden cost of older homes, it look good on paper, right? The pro forma looks good, the numbers look good, but you need to take a reality check. You have to look yourself in the mirror. Did I buy a good deal 4 or 5 years ago? Yeah, maybe at that time it's a good deal. Now, moving forward for the next 10, 20, 30 years, what do you think? Have you looked into deeper? Have you looked at the common, capital expenditure killers? HVAC, your heat, ventilation, uh, uh, air conditioning and all that, one of the electrical system fails, is 5 to 8 grand out of pocket at least. Roof replacement, 15 to 25 grand. Plumbing surprises, 10 grand at a time. The results sink your 8% return closer to 2%, right? So a lot of you don't factor in, you just think about cash flow, cash flow. You don't factor in the maintenance, the upkeep, the vacancies. It all adds up, I mean, you just have to know how to run the numbers, know how to underwrite the deals. A lot of people, they don't do a good enough job, right? They focus on the hypothetical return. They overhype properties that are promoted by those fake real estate gurus all everywhere. Those YouTubers, they know how to market their properties. They entice you to buy this high return on paper. They fail to factor in all this extra cost, which I just mentioned. All right, so you have to be careful who's promoting the property for you. So, don't get mesmerized by this fake real estate gurus that are selling their type of properties uh, to you. All right. So anyway, so here, look at this typical. This I see people buying these properties all over the U.S., especially the Midwest. I hate to harp on the Midwest, but you know, everybody follow the crowd. Everybody follow the herd mentality. And you buy this kind of cheap properties in the Midwest, high cash flow on paper. Look at these types. Look at this. This is 100-year-old houses by now, right? That you still own. Some of my friends, they own 100 properties, 150 properties on this type of properties. And they tell me, like I said, they're increasingly telling me, hey, see, Wing, I need to get rid of these properties. I can't deal with this long term. I need to buy better properties, higher quality assets, better neighborhood, mainly in Florida and Texas, and feel Sun Belt state where I can cash flow, where I don't need a second job, right? I mean, I can, take back my time freedom as I'm getting older into my age 50s and age 60s. There's no way those people out there will continue to manage this portfolio of older, aging properties. All right, it's just too much stress. If you want to simplify your life as you get older, you can't be buying this kind of junks. Hate to say this, right? They all junks, right? You need to buy higher quality asset. These junks, look at this. They're all located all over the Midwest. You know what I'm talking about. And look at this, right? Look at typical houses. Very, very right. So look, you have to factor in. Look, this is a C-class properties. We're talking C-class maintenance, double-digit maintenance cost, vacancy. Not only 1 to 4 units, right? When you buy apartments units, 5 units, commercial in those Midwest markets, it's same kind of scenario, right? You have to factor in this maintenance and vacancy, the C to D class quality tenants is not sustainable. You can't survive years later. At the beginning, yeah, you can feel good about it. You make a lot of good money, but okay, all right. So, oh, look at this. It's just very. Instead, so you need to look into much better, higher quality houses, higher quality assets, better rental market, better quality tenants. And this is the typical type of property you should buy, like, oh, this is a this is kind of higher end, 300 grand, $2,000 rent. But you have to do the underwriting, do the performance. Some of the properties we have within our portfolio in Texas, North Texas. Look, it's not even 200 grand, brand new. Look, at rent for $1,400, cash flow a couple of $100, right? And in Crandall, in North Texas. I'm just giving you a very small sample. 234K, brand new house, A class neighborhood, A minus class tenants. Look at the square footage, rents for 1,700. Cash flow for $612 at 25% down payment. This is the type of emerging market, new construction, turnkey property that cash flow, that are created by the builder, work with the property management, and you're getting a lot of good incentives, builder rate buy down, 3.99%, builder buy down incentives, and first year property management is free, and they pay some of your closing costs. And, these numbers, this kind of quality asset. Look at Sherman, Texas, for example. This is a duplex, 432K, right? These are duplex, and rent out for 1750 per side. You at 25% down payment, you net more than $1,000 net positive cash flow. And look at the numbers, look at the numerical returns. Look at another fast-growing area, North Texas. These AI high tech boom in Sherman, Texas. 30 miles north of the DFW metro. Brand new, $211,000. Rent for 1,700. Cash flow almost $600. Right? Builder rate buy down, like I said, right? 4.875%, 30-year fixed rate buy down. The property management for the first year is free, closing cost incentives, and the numbers really is pretty much amazing. Look at them. Okay, the taxes you don't have to pay the first year, but the net cash flow for the first year is $866. And Princeton, one of the fastest growing boom towns in North Texas, similar. This is a duplex, brand new, almost brand new duplex, good quality property. It's just a sample. So at the end of the day, you really need to evaluate your portfolio for the long term. I know you want to become a long-term investor. It's time to pivot. It's time to get away from this older stock because it'll destroy your returns for years to come if you don't pivot, if you don't adjust. The ability to adjust and adapt as a long-term real estate investor is key to financial freedom. All right, so that's my takeaway. To take a hard look in the mirror. You have to ask yourself, how is my portfolio doing that I purchased 3 or 4 or 5 years ago? All right, is it still achieving the return that I want? I mean, in the future, as I get older, as I'm about to ready to retire, do I still want to manage this older, aging houses that'll give me a lot of headache and stress and I need a second job. I may even need a full-time job to handle my portfolio. You can't, right? That's too much stress. You need to simplify your life. You need to step away. You need to get the passive income you deserve. You don't need a second job, right? You need time freedom, so you can do the things that are important to me, like I'm doing, right? I'm traveling full time, not only recently, for years and years already. So you can do the same thing. I don't know what is your passion. What are your goals? How to define the quality of your retirement. You need to look ahead. You need to evaluate everything, all aspects of your life. So All right, with that in mind, thanks for watching. I'll let you go right now. So please like and subscribe to my YouTube channel if you see any value whatsoever from this presentation. And better yet, put your email on my website below so you can become a free member of my real estate investment community so you can get great real estate free education coming to your email inbox every week to learn more about real estate investment opportunities. Thank you for watching. This is Si Wing Yi from the Yi Real Estate Network. I will see you on the next video. Have a nice day. Bye bye.